Thank you so much for everybody for attending today. We really appreciate you coming. Enjoying this beautiful weather and that kind of stuff. We were just talking about how nice it is, and so we should enjoy this while we have it. You know, we're always excited to do these. Once a year, we try and take and flip the topics back to things that cover taxation, you know, financial issues, investments, some of the different divisions and stuff that we work in. And we really call this kind of our to-do list this time of the year, right prior to the time that people are really doing their planning and really thinking about how do we budget and what do we need to be doing. So in front of you, you have a full set of handouts of the presentation. If you'd like to have what we do today in electronic format, just let us know. We'll be glad to fire that back off to you and make sure you get it. We also have a Cpd Evaluation Form, and we need you to turn that in if you'd like to have the CPE credit. We'd be glad to track that and do that for you. And then we also have an evaluation form if you'll let us know your thoughts on topics, what we're doing today and that kind of stuff. Also, just to remind you, all of these presentations are videotaped if the presenter will allow us to do that. We do run into some SEC, FINRA type issues, those regulatory type things periodically where somebody's compliance department says no, but most of them are in a vault sitting on our website. So if you want to talk to somebody or you want a piece of something to use, again, let us know. We'd be glad to get those to you. This morning's panel consists of three of our gurus, okay? And what we have internally is people in different divisions that basically spend their time in specialties. So this morning we have Mark Levine, who's one of our tax managers, and then Ryan Sawyer, who's senior in our financial reporting group, and then Curtis Harris is a managing director in our wealth management group. And each of them are going to talk just a few minutes as we flip through slides about different areas and different topics that they feel like need to be covered. Talking about their backgrounds just a minute. Mark received his accounting degree and master's in accounting from the University of Miami. He was with Alvarez Marsal Tax in Miami for a number of years, and in 2016 joined us. He has more than 10 years of federal and state and local SALT experience and has been involved in quite a few different tax issues over the years. Ryan Sawyer, who has been with us in the accounting group now since 2010, graduated from the University of Arkansas in Little Rock with a Bachelor of Science in Accounting. Started his original career in Little Rock area with a firm there, moved to Price Waterhouse here in Dallas, and then ultimately joined us in 2010. Ryan is also a CPA and a CFA, and also works over a lot in transactional stuff in the investment banking area. So he has the joy of moving back and forth and having to work with both the audit and financial side, as well as Simon Martin and myself in the investment banking side. And then Curtis Harris. Curtis is an 18-plus-year-old veteran in the financial services industry. I've known Curtis so long, so I remember when he was in high school and college working in his mother's office, okay? And so we go way back. And really he was about 10 and I was 20 at that point, and his mother taught both of us a lot, right? But Curtis has been a veteran in that space for many years. He spends a lot of time working with individuals, family offices, working with family wealth, and helping people attain and set their goals. He's a well-known planner in Dallas. He's been featured in a lot of national and regional publications, including USA Today, the Dallas Morning News, Senior Advisor Magazine, and Fox News. In 2012, he was recognized as a 5-star wealth manager in Texas Monthly. He's also a speaker in a lot of different venues. He has a CFP license, as well as a chartered financial consultant and a certified fund specialist. He has his BBA in finance and modern portfolio theory from Texas A&M. Didn't know that A&M did that kind of stuff. And then, in addition, he received a certification in international business and finance at Texas A&M. So we're delighted to have everybody, and we're just going to jump in today. Feel free, if you've got questions along the way, stick your hand up. We'll answer those. We'll also have a Q&A at the end. We're going to try and move back and forth between the topics and stuff some. This was just another year of changes and stuff, and I'm going to let Mark start by just talking about taxes and the projection and some of the different things that have gone on in that space.
Yeah. So now that we're getting closer to the end of the year, this is a little bit earlier than last year's presentation, but still we should have already been starting to think about planning for the upcoming tax year, we still have time to make some, efforts to, increase our deductions in certain ways and stuff like that. Now, if you're here last year, a lot of these are going to look similar, because while there were some changes, a lot of the stuff has stayed pretty much the same this year. With regard to the rates, the only real change is that, just every year they increase the brackets a little bit for, inflation and everything like that. So some people may, shift into a lower bracket if they're closer to the border. One of the big changes that they have made this year, they updated the depreciation regulations related to the new tangible property regs, and they increased the amount for non-AFS filers, audited financial statement filers, to $2,500 instead of $500. So what that means is that with regard to your expenses and your capital expenditures, you can actually deduct up to assets up to $2,500 rather than the $500 limit that they had before, which gives a little bit more opportunity to do some tax planning around that, to go through your expenses and determine whether or not there's opportunities to accelerate some deductions that you may be capitalizing into fixed assets currently. On the other hand, everything else for the most part has pretty much stayed relatively the same. So when you're planning and going forward, what you want to try and do is look at your tax situation, see what it is, especially in this year with we're going to talk about it a little bit later with the elections coming up, when we don't know what's going to happen going forward, because both parties right now have a very different approach to how they're approaching the tax regulations. So it's definitely good to look and see, what each one's doing and how best to determine what you want to do. Look at your opportunities for, accelerating deductions or deferring the income. If we anticipate that the rates are going to go up. If the rates are going to go down, maybe you want to bring, do the opposite. So those are kind of things that you want to look at when you're going forward in planning. And especially one of the other things that they've done is they've made the 179 deduction permanent. They did that last year. We're going to talk about a little bit later the extenders, and what was up in the air in the past this year actually may not necessarily be up in the air anymore. So with regard to 179, if you're looking at your company and your company is going to be in an income tax position, it may be beneficial to start looking at, maybe we should go out and buy some capital expenditures, go buy some property, utilize the 100% deduction for 179. If you're going to be in a loss position, maybe taking advantage of the bonus depreciation, increasing your NOL for future purposes. Those are some of the things that you want to look at going into the planning, and you have to spend time looking at what your situation is, where your financials have you set, so that you can kind of look at what opportunities are out there. On the individual side, looking at whether or not you're going to anticipate some losses from some investments that you have, potentially selling off some assets that have some income, waiting the 30-day period, repurchasing them so that you recognize that income so you can offset the losses. These are all different things and planning ways that you can go about, minimizing your taxes. In some situations, you want to look at it and say, and see whether or not, if the rates are going to go up in the next year, then you want to actually bring income into this year. And so maybe it is, if I look and I say the rates, I'm going to end up in a higher bracket next year, then I should sell off some of those assets that have gains, recognize the income this year, recognize the taxes this year, because I'll save it on the end in the following year. Some other things, charitable contributions, a lot of this was discussed, I think, in last year's presentation as well. It all is kind of the same. If you're planning on giving off stock to charity, it's better to give it as a stock donation rather than giving it as selling it and then giving the cash. The normal things. One of the big things that's going on coming up in the new year, which is on the next slide, is the tax return due dates have changed. And this is going to impact a lot of people. Now, in your slides that you have in front of you, it currently does show that the corporations, the 1120s, as being October 15th. That's only if you're a corporation that has a non-calendar year or a non-June 30th filing. They are going to be pushing towards a October 15th come, I believe it's starting tax years 2026. But for now, it is still currently September 15th extended due date. But the actual due date for extensions is now April 15th for corporations. And I think one of the reasons why they decided to do that was all the issues that they've been having surrounding companies receiving their K-1s on time and be able to file timely. So what they've done is they've pushed up partnership returns to to March 15th and moved the corporation dates to the April 15th deadline. Another one of the things, if you have any foreign assets, the foreign reporting requirements have been moved from the June 30th, which was a hard deadline. There was no extensions in the past. They've now moved those to April 15th as well and allowed for the 5-month extension, 6-month extension to October. So that gives people a little bit more time with regard to those foreign reporting requirements to be able to get those done. If you deal with any exempt organizations, they no longer have the 2 extensions. They just give you the 1 extension to November now. And so those are some big things to kind of consider when you're moving into next year, and knowing that if you have partnerships, the extension is due actually sooner than it was last year, and that your corporations, you have a little bit of extra time to get that extension prepared, and if you have any payments due, to make those payments. Yes?
Do S corporations follow the partnership rules or
The S corps stayed the same. The S corps did not change, and it's the same. If you look at it, an S corp is very similar to a partnership, so it was the same concept. They want to make sure that the K-1s get delivered on time. I think there was a lot of people, and we dealt with it in our office. We were getting K-1s the day of the deadline, and it makes it almost impossible to get things done and get things done properly. So what they've done is they've done this shift, I think, because they've had a lot of complaints with regards to that. So.
Texas R&D.
And I left the Texas R&D in here from last year just to kind of put it out there and keep it on everybody's mind that you have the ability to take an R&D exemption in Texas. But nothing's really changed with regard to that. I just wanted to make sure we left it in there to keep it in your minds to think about it as you're going forward.
And same with the franchise tax credit. Yeah.